Okay. All right, so I've started the recording for tonight, so welcome back. So tonight is going to be our valuation session, and we'll talk about the Starbucks valuation, and we'll do another example tonight of YUM, and then I'll show you the data available to start working on your team projects relative to the valuation and other tools to get us set up for the next 2 weeks. So again, what you should have turned in for tonight is what we called an as-is and a target valuation for Starbucks. So I'm going to open up the file and share it here. That you turned in. Share my, let's go ahead and share my desktop. It'll be easier. So basically, what you should have completed by watching the videos and starting with a file was essentially a valuation model that will be reusable. And we're going to call this the as-is valuation of Starbucks. Now, basically, just as a refresh, what an as-is valuation involves, because I'm sure that language is not familiar to you, is we're working backwards from a company's current stock price and using the academic cash flow formulas to figure out basically what the math would have to be to equal the current share price. And, you know, basically put a rough standard of to try and get as close as possible. So I said $1 of the current share price. And so what we've done with our reusable model, just again as a summary, is from the forecasted income statements and balance sheets that you created, the model created some forecast cash flows, and then the forecast cash flows were discounted to basically create a share price. And that's kind of the flow of the model. But the most intriguing part of the model is the what-if nature of the model. And again, the most important part following Modigliani-Miller is obviously the operating cash flows, which are driven by the free cash flows, which were off of the CFI, which is why you guys converted the CFIs last week. And that was being driven primarily by an assumption of financial ratios. And what we also did in the videos as a summary is basically we worked backwards to try and understand what some of those ratios could be. And we talked about the 5 most important ratios to the valuations of free cash flow. Proxy for gross cash flow, revenue growth, EBITDA tax rate, gross investment being everything on the balance sheet tied to revenue, creating gross investment, and in the growing perpetuity, the G, as well as the WACC. Those are probably the 5 most important things in any valuation. And again, we'll call that the 90-10 rule as opposed to the 80-20 rule. And so basically, if you follow the video, you got to a share price, hopefully, of about $71. And that was about the share price of Starbucks 2 weeks ago when I shot the video. So before we talk about the target valuation, just any general questions about the as-is, what you did on the assignment, or just any other general questions. Let me open up the floor for a second.
I actually have a question about the next assignment because in Elms,
Yep.
It looks like it's due April 10th, but is it due next week on April 3rd?
Let me double check that before we leave class tonight, but your next assignment should be April 3rd.
And then the midterm, is that also due next
The
Because that's dated for the 11th or something like that.
Yeah, the midterm is going to be due between the end of next week's class and our final class. So it's kind of more like a final exam than a midterm.
Okay, because I think everything on ELMS is off by like a week.
I will double check that before we leave class tonight.
Okay.
Yeah, ELMS also says that we don't have class next week. It has us in class on like the 10th and 17th or something like that.
Okay. I was told we had 5 straight weeks of classes, but again, we'll double check that. But my understanding is yes, we have class next week. So let's come back to the model itself. Questions about the model or what you did on this assignment?
I kind of just have a general question. I mean, I used logic to change a lot of the assumptions, but it doesn't really affect the stock price, which is kind of what I expected. I mean, were you expecting some type of like drastic overvaluation or something to that effect? I'm just curious as to kind of like what the baseline is, what you're looking for coming out of this. Not that there's necessarily a right answer or anything.
Well,
Just curious.
So part of the reason for the way that I structured this assignment is I look at this as assignment more of a process assignment to help you sort of start to understand what it really means to put together an enterprise DCF model and to basically start getting an assumption or an understanding of what we've been calling the key values in the book and in the class, so that you can start to understand that, hey, if I change growth or I change margin, that it's actually going to affect cash flow and affect value. The other part of this is to relate it in the context of the real world. So part of what we're going to do tonight is that you took a swag or should have taken a swag when you did your target stock prices for this assignment. And now that you've kind of started and hopefully gotten a little familiar with the model, we're going to get a little bit more refined about how we make assumptions. And that will help you the next time you go through with your group projects. But yeah, today was a little bit more of getting a feel for things than necessarily having like the right answer for what Starbucks stock price should be in a year. Although, again, if you're realistic in your assumptions, this is a real model. It can predict a real stock price. So obviously we want to be somewhat realistic in some of the choices and assumptions that we are making.
Yeah, I just wanted to confirm that there wasn't like some golden egg or something that I missed, that.
Well, the nature of this class, to be honest with you, in the real world is that we are predicting the future. And so if you could actually get that golden answer or golden ticket, please see me after class and we can make a lot of money. But that's actually one of the challenges is that, even in grading, when we get to this assignment, it's a little tougher from a grading standpoint because I can't necessarily say every assumption you make is wrong. And so part of it goes back to process. And there really is, to some degree, an art of valuation. Is that one of the things you should quickly realize is that valuation mathematically is actually not that difficult. I mean, there's a lot of algebra involved, but it's algebra. It's not calculus, and it's not heavy math. It's really about the assumptions you put in. That has much more to do with the valuation than the math itself. You can teach a 12th grader the math. That's not the hard part. And that's hopefully some of the things you'll start to realize as we go through tonight's class. Other questions or thoughts before we dive in deeper?
Yeah, so I had a question regarding, the as-is valuation, really any of these models, the first page where it says model data.
Yep.
If we wanted to take the spreadsheet and reuse it, what is the format that you used for this? Like, how would we take another company and put that information in, or do we have to fat finger it all?
Well, so just the context that you may or may not be missing is that behind this spreadsheet, if you can see my screen, is Bloomberg. And so, for example, one of your companies tonight is Royal Caribbean. And one of the things that a data service, and there are several of them, there's FactSet by Standard & Poor's, there's Thomson One by Reuters, there's Mergent, and then there's the King, which is Bloomberg, basically aggregate data as companies file them. And Bloomberg has, and you can see it here, what they call a standardized income statement and a standardized balance sheet. And so across, the Global 1000, what they're doing is they're taking all of the as reported data, which nobody reports it the same way, and puts it into a more standardized format. And so, but one of the things I've learned from Bloomberg is they actually have 5 standardized formats for the S&P 500. So even though their format is standardized, it's not as standardized as you think. So what I actually tried to do is, in the model to make it reusable, is create a standardized income statement, purely standardized income statement that works for non-banks. Banks are a separate animal. We're not covering them in this class. And so I've been aggregating from Bloomberg all of the database fields that they're reporting that they feed into a standardized income statement and a balance sheet. So if you were to reuse this model and you didn't use Bloomberg, what you need to do is you need to create these standardized income statements and balance. You can either do them directly, or you could take a data feed from another data source and then map it to this model. But that's basically what makes the model reusable. And that's actually something we practice, because, for example, with Caribbean, what I have done for you guys, or all of your teams, you can see this uploaded on Elms, is I've actually taken a data feed of their data, which you can put into this model, and then use this model to value Royal Caribbean or Nike, yes, whatever the fourth, Halliburton is the fourth company. That's part of what we're going to be talking about tonight. All right, other questions, comments before we kind of jump in a little bit more detail?
Yeah, just a quick question.
Yep.
I was just more of a general question. I was wondering, because it is model building, this is kind of an inexact science. I guess finance wouldn't be the only field where it is so. How has it changed? For example, if you were to compare it, 20 years ago, 25 years ago to today, has it become more accurate? And if so, has that been because of the type of data that's been at the fingertips of the analyst, or what are some of the reasons for that?
Well, so I'll give my own personal history, because I'm getting old. Just turned 50. And that about 30 years ago, I was at Wharton and I was doing this stuff. And basically, first of all, the tools are better. We were using VisiCalc and Lotus 123, and Excel is far more powerful. So that's the first part, GUI interfaces. Second is availability of data. We used to get quarterly reports from a company called Value Line. And the best you could do is look at data maybe 3 months after the fact. And more importantly, the best you could do is look at historical data. There was very little forward-looking data. And I think the biggest change in the last 30 years, beyond the fact that tools are more powerful, is we're getting much better information on forecasted forward-looking data, even though the world is more complex. So for example, and this is what we're going to deal with this class, is that what makes the valuation is not the historical data, it's the future forecast, the future cash flows, and a better understanding of what those cash flows are, and better tools to forecast those cash flows. And that's really, I think, what's changed about modern corporate finance, is that we're able to deal much more with the future than we ever were 30 years ago. And every day we're getting better and better at that. And so that's how the finances evolve. Formulas haven't changed all that much. The math is the math. DCF is DCF, NPV is NPV. That hasn't changed since the 70s in Chicago. But what has changed is how we're making those assumptions. And like I said, the ability to look more into the future. And to real time the information. I mean, basically, if you look at the data that starts coming out, even today, Boeing has an announcement about the planes, when a Southwest Airlines has an emergency landing with a 737-8 MAX. I mean, literally within seconds, the market could start reacting to that. That could have never happened 20 years ago.
Okay.
All right, so back to your assignment. So back to the as is. What you really needed to do, as I said, is working backwards, you should have come up with some assumptions, and this is what we followed in the video, to basically justify the current share price. So what we know going in is that somewhere around 6% revenue growth, or let's call it mid-single digits, is what the market's expecting for Starbucks for about the next 6 years. EBITDA margin somewhere around 22%. Tax rate somewhere around low 20s. And basically a long-term G of about 4% into perpetuity is what the market's kind of expecting from Starbucks to justify a $71 share price. That's basically why you do an as is. And in the real world, a lot of people don't do an as is. They will skip this step. And I'm not saying you have to do this step. This is actually a step I encourage, and obviously in the class I'm making you do. But I think the value in this step is before we go to the next step, where you start putting in what I consider your opinion for the valuation. It's kind of good to understand what kind of the wisdom of the crowd is. What is the market thinking? Whether or not we agree with the market, but this is kind of what the market is thinking about Starbucks today. And Starbucks is being priced using close proxy for these assumptions. So that leads then to your next part of your assignment, which is the target. So the big difference between the as is and the target is now your opinion. Meaning, do I believe that Starbucks, giving an assessment of the market, now again, I don't think you guys probably went too deep on this, but given the assessment of the market, is going to grow at 6%. Do I think they're going to grow at 8%? Do I think they're going to grow at 5%? Like, what growth rate do I think Starbucks is actually going to achieve? Or do I think they're going to maintain this margin? What margin do I think that they're going to see? Or what do I think is going to happen to the tax rate? For example, do I think the Democrats are going to win the Congress and they're going to basically repeal the corporate tax rate? That's a possibility I could actually model out and see what the impacts would be. So again, I now get to put in my opinion, and based on that opinion, tell you what I think the share price could be, and that creates the concept of a buy-sell hold. So just out of curiosity, what were some of the opinions that you guys did as part of the files you turned in? What were some of the choices that you made? Does anybody want to share some of your thinking? Just generally on growth, margin, taxes, G?
Yeah, I think one of the things that I did was I increased revenues a little bit, and that was largely based on some of the things that they have going on with Nestle and in China and things like that. So I put that up a tick. And I also, and I wanted to get your thoughts on this, I reduced shares outstanding because there were still, at least it looked like they were still in the process of buybacks.
Yep.
So I ended up putting it at about 1,150, just with the current trend that their shares outstanding were going in, because they've gone down consistently over the last 4 years.
Okay. So one word about the shares outstanding. In context of the model, this model is not really set up to forecast directly share buybacks, dividend increases, debt repurchases, etc., because the short answer is they have zero impact on valuation. So they're irrelevant to the valuation of a firm. And I want to be specific about it here. It's a good question. By looking at the CFI, because the real value of the firm is the cash. I'll make this bigger. That the cash that the firm is available to distribute to an investor. And what you can clearly see on the CFI is row 13 is the cash generated by the firm. It's called the free cash flow. And whether you buy back stock or pay dividends in the future, it actually has no impact whatsoever on the free cash flow, and therefore has no impact on the CFI. And so that's the point. You have cash to distribute. How you distribute the cash does not affect the cash that you have generated. So whether a company takes the free cash flow, pays off debt, pays a dividend, buy back the stock, it doesn't change the free cash flow, and it doesn't change the underlying enterprise value of the firm. The only thing it can do is it can manipulate the share price because there's fewer shares outstanding. So therefore, I get a bigger piece of a smaller pie, but it won't affect the actual value of the firm. So essentially, we don't really want to forecast. And that's why people use, when they do enterprise DCFs, they use the idea of a target capital structure, because they realize that changing the capital structure doesn't really change the value of the firm, right? Because the real value of the firm is how much cash you generate. So the way the model does account for this, because eventually you do have to return the cash, is we account for this in the model, and you can see this here. The reason why the CFI does not change in the out years as Starbucks makes more money is because what the model does is it just sticks it in excess cash. So what you'll look at, and you can see this on the actual balance sheet, is as Starbucks makes more and more profit in your forecasted future, it's right here, the excess cash balance just keeps going up and up and up and up. This excess cash balance is the amount of shares that can be repurchased in dollars, or dividends that can be distributed, or debt that can be repaid. So from a model standpoint, we separate out the value of the company from how that value is distributed to stakeholders. Now, don't get me wrong, the stakeholders want to fight for the pie. The debt holders want a slice, the shareholders want a slice. We can optimize that. But optimizing the pie still has, in 2024, $35 billion to be distributed. So the model is actually set up not to worry about the distribution, but to actually talk about how much is available to distribute. So as you change the share count, it actually didn't change your valuation. Just FYI, conceptual.
Joe, can I ask a question?
Please.
I noticed that in addition to the share buyback, it seemed like Starbucks changed its leverage structure. So it looks like they bought back shares and they sold some capital assets, but they also took out a lot of debt.
Well,
So
that's the CFI analysis right here. That's the debt you're talking about. That's increase in debt, and that's the historical share repurchase.
Yeah, but my question was, are you saying that you made a comment that the capital structure doesn't change valuation? So, like, could you argue that they're using their capital more efficiently because of the tax benefit or tax shelter, and maybe they could improve ROIC and improve valuation, or is that?
Well, I want to stop you there. Changing the debt and equity does not impact the ROIC because it's not going to impact the actual invested capital, because the invested capital is not the debt and the equity. The invested capital is the working capital and the PP&E. So changing the debt and equity doesn't change working capital and PP&E. So in our model, which is an operating model, what it says is, and you can clearly see it here, is that in 2018, they basically repurchased almost $7 billion worth of stock and $1.7 billion of dividends. Well, in 2019, they have $3 billion of free cash flow, and right now, if they don't pay it out, it's going to the bank. That's basically what's happening here. So this year, Starbucks could pay $1.7 billion in dividends and still have $2 billion left to either put in the bank, or actually about $1.6 billion left to put in the bank, or buy back stock. If it wanted to keep buying back stock at this rate, it would have to keep borrowing money. That would be the change in the capital structure. Okay, but the point is, the sustainable dividend, or the sustainable share repurchase, which is the real value of the firm, is the free cash flow. That is what can sustainably be paid out by the firm. Otherwise, to pay more, you're just robbing Peter to pay Paul, essentially. And you can see that once you start to understand what's happening here on the CFI. So the point is, back to value, the real value of the firm is how much free cash flow you're generating. It's not the debt or the equity. Because if I borrow debt and I just put it in the bank, it doesn't actually change my working capital. It doesn't change my PP&E. If I buy back stock, it doesn't change my working capital. It doesn't change my PP&E. That's the real invested capital in the firm, unless you take a financing view. That's the traditional ROIC that I mentioned in the video, and they also talk about in the book. The operating ROIC is working capital and PP&E. You really want to get rid of that? Get rid of inventory. Get paid faster by a supplier. Don't pay your bills. Use less facilities to manufacture the products and services you sell. That improves your invested capital. That's the model's view of cash flow. Other questions about this? These are good questions. Kind of testing the understanding of how finance works.
Professor, I had a quick question. just based off of my valuation model, and I kind of took a wild guess on one of these. Well, one thing, I increased the growth rate by a very small percentage, like 0.2, just because I knew that they would grow a little bit more given their international presence in China and the deal with Nestle and deal with Uber Eats and Alibaba and all that good stuff. I mean, I was very conservative, but I did increase the growth rate. But my question was related to the PB multiple of long-term investments.
Yep.
So one thing I did just on the assignment is the current share price. Something that I was able to change was I just went to that day. I think I did this on Saturday or Sunday, something like that. I changed the share price to 72.30, which is what the share price was for that day. To get to the model share price, I changed the PB multiple of long-term investments from 1 to 3, thinking that, just because of the fact that they were going overseas and they had all these longer-term deals going on, that the multiple would go from 1 to 3. But I had a question because I kind of took a wild guess, not knowing a whole lot about how it worked. However, I did see that it did modify the model share price to get it pretty close to what the current share price was.
Well, again, the short answer to what you tried to do was, if you look here in 2018, Starbucks has long-term investments of about $268 million. So what that basically means is Starbucks has made passive investments in other companies of about $268 million. So let's say there's a person here who can't see, called Tony. So Tony's company, Tony's Exco, I give him $267 million for 20% of his business. I don't run it. I just own it. So the point is, I don't know what it's worth. So when you raised it from 1 to 3, what you're saying is the business that you invested in that's on your books is not worth 267. It's worth close to 750. So that's what you changed. And so the one challenge with the PB of the long-term investments is you have to know what it is. Because right now, unless we did our diligence, we don't know what these $267 million of investments that Starbucks has made. I don't know if they own pieces of coffee farms in Latin America. I don't know if they own distributors. I don't know what they own. And there's the problem. It's hard to value. And this is where you need to get a little bit more familiarity with the companies themselves. So generally for this assignment and for the assignment you're doing with the companies that you picked, you're probably not going to mess around with that. This is something you mess around with. As I said, Lyft just did an IPO. General Motors owns a piece of Lyft. The stake that General Motors has in Lyft, that one you might value because you have an IPO price that's a lot higher than what General Motors invested in. That's where you would go in and mess around with the PB. So unless you know what it is, it's kind of hard to guess what it is. But what you just did is you just said it's worth 3 times what they paid. That's actually what you did, just mechanically in the context of the model. So as I said,
why did the goodwill change by so much this year?
they did an acquisition.
Only like if you buy it, you can.
Well, that was between 13 and 18. So let me unhide. But you can see that when goodwill goes up, and it went up dramatically between 17 and 18, that means you bought somebody, because goodwill only comes from purchase premiums of other people's assets. So they had a big increase, and you can also see this on the CFI. They had a big increase in goodwill and intangibles in 2018. So Starbucks spent several $1 billion to buy somebody last year. So
if I wanted to understand that, I'd have to pull out the statements and look for a note about who they bought.
Yep. So,
and does that change valuation? Like if they buy someone, I mean, it looked like they just financed through like cash and debt potentially, right?
Yep. So my guess is it's this one right here. Starbucks bought Teavana last year, one of the tea companies, and that's probably one of them. So I don't know. We can go back to acquisitions in 2018. There was another one. But the point is exactly, this is where you get out the footnotes. This is where Google is increasingly making it easier to do this. Acquisitions in 2018. See who they bought. See what they actually list. But the point is, I
couldn't find it, so I couldn't explain it in my analysis. Like I think they sold Teavana last year, and it looked like they bought someone, but I couldn't figure it out.
But the point is, we could actually go through the notes and we could figure it out. For purposes of this assignment, I wasn't requiring you to do that. Although if this were your group project, if this were Halliburton, they did a big acquisition, it would be worth mentioning in a couple weeks when you guys are presenting your group projects.
Okay.
All right. So let me just kind of preface some of this by going back to the buy, sell, hold opinion. So in the class, I'm going to ask you to make a recommendation for a target price. And the whole point of the recommendation is to create a buy, sell, hold opinion. And basically, the idea of a hold is it's a 12-month target share price. And it's easy to see by looking at Bloomberg. So again, I'll try to show you this here. But if we go back to Starbucks today, what you can see is these are the 33 analysts that are covering Starbucks today. These are the scrollable list. So Nick Sechin of Wedbush, Andrew Barish of Jefferies, blah, blah, blah. And they have the buy, sell, hold opinions. What they're actually doing is they're creating target share prices, which is what they think, just like you did, Starbucks is going to trade for in the next 12 months. So right now, of these 33 analysts, right, basically 24 of them have put in guesses to Bloomberg, and the average of the guesses is $70. And right now, Starbucks closed today at $72.74, which means that in the next 12 months, the analysts predict that Starbucks is going to see its stock price fall by 4%. And part of the reason, and I mentioned this, I think, in the video, is that in the last 12 months, Starbucks stock price has gone up almost 30%. So what the analysts are basically saying is, given the big run-up in stock price recently, we think Starbucks is pretty fairly valued, and we don't think it's going to go up anymore. That's why so many analysts are in the hold category. Because what they're saying is, and the hold rating basically says plus or minus 10% of the current share price is typically considered a hold because it's a trading range. And we're saying the company's fairly valued. It might bounce around a little bit, but there's no catalyst that's going to make it go higher. Therefore, I'm not going to recommend you buy the stock. It's called a hold. So to convince you to buy it, I have to believe that something is going to cause the stock to go up more than 10%, which there are a few analysts that feel that. You can see that. They're pricing it closer to 79. And then sell is somebody believes it will go down more than 10%. So those are the people that think that Starbucks could be worth $56 a year from now. This guy, Michael Pone from DZ Bank. So there's some pessimists out there and there's some optimists. And that goes back to the real world, is that there is no unanimity about these target stock prices. And so that goes back to the assignment. So the point is, what's going to create this range is your purview of what's going to happen. And so we go back to the key drivers to growth. Because if I think growth, and this is what some of you probably did, is closer to 3%, well, then I'm closer to a $66 share price. And if I think the margins regress to where they were in 2018, then I'm closer to a $65 stock price, right? And if I think that Starbucks is going to have more tempered long-term growth because people are going to start going away from caffeine towards healthier drinks, then Starbucks is going to have a $58 stock price, right? Now, here's what would have to happen. I'd have to get the market to believe that's going to be the case in the next 12 months, because if they don't believe that's the case, then they're not going to trade at that price. So it's about the expectation game. But nonetheless, that could be a target stock price that leads to a sell. Somebody else could have said, no, Starbucks getting into tea, getting into juice, getting into China, Asia, Latin America, they're going to actually increase their growth. And now that they're in food and other businesses, they're going to increase their margin. And considering the G's, they're going to maintain their G. And now I'm at an $82 stock price, and or an $85 stock price, and I'm at a buy. So essentially, that's what you should have done by process and to some degree thought through as you went through your buy sell holds. And that's what I'm expecting you to do as part of your group projects. Now, tonight, I want to add to this. And so I'm just looking at the clock because I want to make sure we finish all this, and we got about an hour left. Basically, in addition to a buy, sell, hold, about 5 or 6 years ago on Wall Street, what Wall Street also started to do is give ranges. And we're going to call those the bull and the bear. So I was working with Morgan Stanley, and one of the analysts came and actually visited my class, and she was doing it on Caterpillar. And she was the analyst that covered CAT. And she actually was one of the first analysts that did bulls and bears. Because what she explained is that if I'm selling my research to an institution and I say, hey, Starbucks is worth $73 a share, just make the number up, and they're currently trading around 71 or 72. Well, that's important information. But remember, if you took modern portfolio theory at Smith or any other school, one of the keys to modern portfolio theory is risk, and risk is measured by standard deviation. So the portfolio manager is going to want to know, what's the standard deviation? How risky is the stock? What could this price be? And that's where the bull and the bear comes in. Because what the bull and the bear says is, how high could the stock price go in the next 12 months? And how low can the stock price go in the next 12 months? And so that range communicates the riskiness of the stock. So the riskiness of Starbucks might be, and this is really what the analysts are saying, if you actually look at this data that I showed you on Bloomberg right now, somebody interpret for me, look here on the screen, upper left-hand corner, tell me the risk of Starbucks. What is the risk that the market is basically saying of Starbucks? And you can even look at the highs and lows of stock prices on the screen. So you got some target prices here. You can see the median is probably around 70 of all the analysts. And there's the data for 12 months. What do the analysts basically say?
Are they saying it's a safe bet? Most people are saying either buy or hold it.
Yes, but I'm interpreting it a different way. Forget the buy, sell, holds.
Oh.
Look at the last price. Look at the 12-month target price. And then look at the prices the analysts are starting to predict. Do you think there's more downside in Starbucks or upside in Starbucks in the next 12 months?
It's like downside, is it not?
Exactly. The stock went up 30% last year. The average analyst is predicting it's going to go up 4% this year, which basically means you don't have much upside beyond where it is right now, according to the average analyst. And to be honest with you, you probably got more downside than upside in the short term. Now, I'm not saying 5 years from now, Starbucks couldn't just blow the doors off. But right now, based on its price, it's gotten a pretty good run. And so what the analysts are basically saying is, even if I'm telling you, I'm Wells Fargo, I'm Bonnie Herzog at Wells Fargo telling you 73 is my 12-month target. They're trading at 73 now. There's no return there to add more shares. Why would I want to go buy the stock? That's why she's saying hold, or she's actually saying buy. I'm not going to be buying, because now I have to start thinking about the risk. The risk is there's not much upside and there's a lot more downside. So this is where the bull and the bear comes in, because the bull and the bear helps establish the range. Because the one thing we're not seeing here is the range, and that's the other thing I want you guys to communicate, which is, and you're going to actually turn in 4 models as part of your final project. The first model is the as-is. The second model is the bull, and the third model is the bear. The bull is the optimistic scenario. The bear is the pessimistic scenario, and the target is the realistic scenario. So when you put this homework in, you gave me what you thought was the realistic scenario. But I also want to know the bull and the bear, because I need to know the real risk of the stock. So is my risk plus 10 on the upside and minus 20 on the downside? Is my risk plus 50 on the upside and minus 10 on the downside? Is my risk plus 10, minus 10? I need to have an understanding of what you think that realistic range is, and more importantly, what are the catalysts for that range? And that's the other thing that we need to practice. So we got 2 things to do. And I'm going to do it with McDonald's. and then with YUM brands here in class tonight. So first, I'm going to start with McDonald's. And these files, by the way, that I'm about to go through are in Elms, in the files folder. I made some updates today, in a file called MCD. They're right here. And there's a video that's an hour that shows how we got from the Starbucks folder to the McDonald's folder, which I'm going to give you the Cliff Notes tonight. But if you want to see how it was derived, I posted the video of how Starbucks became McDonald's here under modules. I put it under module 3, and it's called Starbucks, McDonald's, Bull Bear, and Final. So everything I'm talking about, more detailed step-by-step with screenshots to see what we're about to do. So 2 things in this McDonald's file. So let me kill the Starbucks file. All right, number 1 is we added some data down here at, let me go back to Starbucks just so you can see it. I added some data down here at the bottom of the Assumptions tab. So first is, I don't think did we get down to the G? Did I show you how to estimate a G in the video? And to estimate the margin? Trying to remember if I showed that in the video or not. I don't think
I don't think so. I think it was an assumed rate, like 2% for growth.
Great. So in the video, and this is a preface of what you're going to learn next week, when we get to multiples, multiples are an expression of growth and spread. You actually derive multiples from the key value driver equation. Kind of highlighted it 2 weeks ago in class. So next week in the videos that you're going to watch and in the assignment, we're going to actually use multiples to basically understand what is the expected ROIC, the growth, and the WACC that basically leads to a multiple. And multiples are just rearranged math. So you rearrange the math to get a PE, you rearrange the math to get a PEG, you rearrange the math to get an enterprise value to EBIT, rearrange the math to get an enterprise value to sales. Pulling ahead next week, 2 things show up, and I put it here on the screen. Number 1, if you take the enterprise value to sales multiple, which is how much I'm willing to pay for somebody's sales based on the price to sales multiple, and you divide it by the price to EBIT, the enterprise value to EBIT multiple, how many times I'm willing to pay for somebody's EBIT. If you divide those 2, you get, by math canceling out, the EBIT margin or the operating margin of a firm. So right here in plain sight, on this day, last week, McDonald's was trading at 8 times sales, 8.09 times sales. And McDonald's was trading at 17.76 times EBIT. If you take enterprise value to sales divided by enterprise value to EBIT, McDonald's EBIT margin was 45.6%. Basically what that means is in our ratios, this number right here, which is the perpetuity operating income / EBIT, had to be 45.6%. So you took a swag at the EBITDA into perpetuity when you did this assignment for Starbucks. And what I'm telling you is the as is, you don't have to do the swag. You can actually solve for that number for the EBITDA based on the multiples. The other thing you can do is there's a formula that you're going to learn next week. It's in the textbook and it's in the videos and the assignment you're going to do to estimate an enterprise value to EBIT multiple. And from the enterprise value to EBIT multiple, if we know the enterprise value to EBIT, we know the ROIC, we know the tax rate, we know the WACC, we can actually solve for a G. So where I told you to basically guesstimate a G, just kind of look at your way the wind was blowing and say, I think the G is about 3 or 4%. I can actually put a more refined G in for a firm. so that if I know your G and I know your EBITDA margin and I have a good sense of your tax rate and a good sense of your EBITDA, I can put in a more realistic growth rate for the firm. So rather than trying to figure out the growth of the G, we can actually solve for that. Okay? So what I want to do tonight, and as I said, there's a video that walks through how all of this got to put together for McDonald's. I want to do it for Yum Brands because this is how you're going to do it for your companies. So sitting in this folder on Elms, the files folder, there is a file called YUM, and these are the files that I'm about to go through. So if you want to follow along, right? So I'm going to start with these two Excel files, YUM data and the YUM valuation model. So let me go back here. This is what I had uploaded. This is YUM data, and this is the YUM valuation model. So here's how it works. YUM data is an export from Bloomberg of 6 years of historical data. Instead of Starbucks, it's for Yum Brands. Yum's is Pizza Hut, Taco Bell, and some of the terrible company.
KFC.
KFC.
KFC. Yes. I say terrible. Terrible for you. It's tasty. Actually not good for you.
Tastes horrible.
Yeah. Anyways, I was trying to be generous. All right, so here's the point. There's Yum's 6 years of historical data. Here's our valuation model. So here's what you need to do. You're going to do the same thing for your company. You're going to take the data in the data tab, select it, the whole tab by clicking on this cell, right-click and copy it. You're going to come into your valuation model. You're going to right-click, paste special values. Don't copy paste special values. And you're going to overwrite the Starbucks data with the Yum data. So now this model has the Yum data in it as opposed to the Starbucks data. And oh, by the way, that's the tree for Yum as of right now. Now, as we update the model for the next company, we're going to start with updating the assumptions. So when you use the model again, you want to check the last reported year. And right now, 2018, so we don't change it. We're going to leave cash at 2% of revenue just to make your lives simple. The next thing we're going to need is we're going to need to have the Yum WAC, not the Starbucks WAC. So I gave you a file that says Yum WAC. If you open it, today, Yum's WAC is 6.7%. Right there. So in our model, we'll type in 6.7%. The next is the shares outstanding. That is going to be on what's called the DES screen. There's the DES screen from Yum. And today, Yum's share count, shares outstanding, is 306.4 million shares. So when we reuse the model, we switch the shares outstanding to 306.4. Now today, and I can see this on the DES screen as well, Yum's share price was at 98.97. So again, I'm going to type in the current share price, 98.97. I also gave you the earnings estimates, the Yum-EEO. This is the analyst estimates for the next 3 years for Yum today. This is revenue, 5471. The 2019 revenue forecast for Yum today. So I'm going to type in 5471 for 2019 revenue. I'm going to type in 5681 for 2020 revenue. And then I'm going to type in 5951, 5,951,000,000, which is the consensus estimate revenue for 2021. 5951. For EBITDA, the analysts today are expecting $2,091,000,000 next year. They're expecting 2213 the year after. And they're expecting 2325 in 2021, leading to these three EBITDA margins. Now, on the earnings estimate screen are the multiples. These are the multiples: price to earnings, enterprise value to revenue or sales, enterprise value to EBITDA, enterprise value to EBIT. And these are also called forward multiples. When we talk multiples next week, we care more about the forward multiples than the historical multiples, because forward multiples are a better predictor of cash flow. And specifically, the market normalizes around the second forward year. Because we're a third of the way through, a quarter of the way through 2019, we have 3 months of actual data and 9 months of data to come. This is the first forward year. What the market wants is the first clean forward year, so we tend to standardize around FY2, which would be 2020. In Bloomberg, when you see screenshots, you forward year 1, forward year 2, historical year. So 2020, right now, enterprise value to revenue or sales, they're trading at 7.06 in my model, 7.06 times sales. And today, for the 2020 earnings, they're trading at 19.1 times EBITDA. So the EBIT margin or operating margin in perpetuity that the market is expecting today is 37% pre-tax. Right? Now, here's the deal. I need to basically start putting some of these numbers into the ratios. So on my ratios, I need to know a couple things. First, I need to know YUM's tax rate. Now, we looked it up today, and the guidance for the company was around 22 to 23%. And last year they paid 22%. So basically, I'm just going to use 22% for YUM. Okay. Next, for
looking at Starbucks model there.
I'm sorry.
I said I think you're looking at Starbucks model, not the YUM one that you did.
Oh, hold on. Model. Thank you. Don't save. There we go. Ratios. Oh, sorry. Tax rate for YUM, 17%. Take it back. That's the number I looked up earlier today. It's closer to 17%. Okay, so I put in 17% for their tax rate for YUM. Okay. Now, let me go back. On this assumptions tab, 17.4% is the perpetuity EBIT margin, which means that's this number. That's this number, 17.4%. That's what the multiples tell us. So since I can't adjust the operating income directly, make it a little bit bigger. What I'm going to do is I'm going to adjust the EBITDA to make that 17.4 by making that 19.8. So basically, the multiples have told me that the perpetuity assumptions for, hold on, make sure I'm doing YUM right. YUM EEO 706.19.1. Yes, is going to be that number. Okay. And then essentially, I have my EBITDA margins here. Something looks amiss.
I think it's the EV to sales ratio.
Yeah, assumptions. EV to sales of
7.06. That's not what you have on the model cover page.
I'm having trouble today. Oh, thank you. I was typing in the wrong spreadsheet.
Yeah.
Thank you. I was like, that doesn't look right. 7.06 and 19.1. So like, that doesn't look right. 19.1, which gets me to 37%. Thank you, because I knew that was a miss. Too many spreadsheets open. Ratios. That needs to be, was it 31? Was my mind here today? 37%. So to get this to be 37% with a 2.4, so that would be 39.4. So basically the market, I can have these just kind of equal each other out. Is using in perpetuity, and I can have between 39.1 is what the analysts are saying in 2021, perpetuity 39.4. If I want to step these up, like 39.2, 39.3, if I want to do a step function. But that's what the analysts are saying, and that's what the perpetuity says. Okay. Finally, the G. If I go to this cell, I can start guessing a G to get the model G that these four numbers academically create a G. This is based on next week's assignment. And this is the observed EV to EBIT in the market. This G will change this EV to EBIT. So I want to get these two in sync. Said another way, 2.7, 2.6, 2.3, 2.5, 2.4, no, 2.5, 2.48. Can't type tonight. 6, 2.47. Somewhere around 2.47% is the G long term that the market is using. So if I come over here, I can actually use in this model, because that was just a G estimator, the 2.47% G for YUM. Oh, by the way, notice that I'm getting really close to their current share price. This is called the as is. Now, the last thing I need to do is look at my sales growth rates that basically get me close to this. And essentially, this is the last model, just kind of coincidence, I'm probably looking at about a 3% growth rate that basically gets me an as-is valuation. So what I wanted to show you, and again, sorry for the confusion on the models there, but in the McDonald's video, and what I just did here for YUM is what you're going to be doing with your companies to basically use this model to update the data to more importantly get this to do this process for the as is for your four companies. And this will create the as is. And that's the process. And what's different in what I showed you tonight than what you did in your homework assignment for tonight is I refined 2 additional steps, which is using multiples to basically help us estimate a G, as opposed to just putting in a swag, and to help us estimate an EBITDA margin in the future, as opposed to putting in a swag, so that the last number that we fill in is the revenue, rather than trying to guess amongst the 3. We can kind of solve more practically for the 3. And this is pretty much close to what the market's thinking about YUM today. Somewhere around a 3% growth rate, somewhere around a 39% consistent EBITDA margin, and somewhere around a G of around 2.5% at a cost of capital of 6.7% is how YUM is being valued in the real world today. This would be my YUM as is. And I would save this file. I know I went through a lot there. If you're able to sort of follow. Questions about anything that I just did?
Yeah, Professor, this might be more of a general question, but so obviously there's many ways to arrive at this like same final stock price as far as changing variables, and you could look at like operating efficiencies and things like that as well. In the real world, when analysts build these models, is it really the stock price that they're like judged on at the end of the day, or is it really the accuracy of the assumptions or variables that kind of go into it? I know that's kind of a general broad question, but.
No, it's a great question. So let me show you. The answer is actually a combination of both. So number one, I'm going to be judged on, and you can actually see that I am tracked. So let me go into, I'll switch here to the firm here. So if I'm Andrew Barish of Jefferies, this is every one of my target stock prices historically for Starbucks. And what I'm going to be tracked on is their actual price and my guesses. The next thing I'm going to be tracked on is I'm going to make guesses, as are the analysts, on EPS, revenue, operating profit, EBITDA, basically about 7 or 8 different numbers on the income statement, mostly income statement drivers, revenue growth, margins, etc., and overall in net income and EPS. And again, the same thing. The company's going to be tracked on whether they're beating them or missing them, and the analysts are going to be tracked at how well they're guessing these numbers against what's reported. Because basically what I don't want to do is I don't want to be consistently far off from guessing and be wrong, because then nobody's going to subscribe to my research. And oh, by the way, in 5 years, these people are all being replaced by algorithms anyways. So their job security is not very strong to begin with. But regardless, I'm being tracked on both the variables that the companies report on every quarterly. So again, generally sales, margin, EPS, and cash flow. And then I'm also being tracked on share price. But everything I put out there, I'm being tracked against, just as the companies are. So yes, you have to be tracked on some level of accuracy. Other questions? So to pivot for a second, let me go to one of your group projects. So in your group project folders, there's a folder here on Elms. I called it the team files, and I'll start with Nike. So here's Nike. So the exact same process occurs with Nike, and I have it on my hard drive. So if I go to Nike, I have 2 files. I have Nike data, and I have Nike. Well, and then what I actually want you to use is I want you to use the YUM file. I don't want you to use the Starbucks file that you submitted, because it could have errors in it. So I'm giving you the YUM file tonight that I just put in here because I know it works. And so therefore, for your group projects, I would prefer if you use the YUM file, not the ones you built, just because I want to make sure that you don't have trouble with the data, putting it in there over the next couple weeks. And I already made the changes for you. So use the YUM file. So basically what I just did for YUM, Nike should do the exact same thing. So I'll save YUM, file, save as Nike. There it is, Nike. Same process. Open up the Nike data, go to the YUM data, and then with the Nike data, basically, once it eventually opens, the computer's slowing down right now. Basically, when it opens, copy and paste the Nike data over the YUM brands data. Then this is the Nike DES file, which will have, for example, the share count. And if you wanted to do it as of today, the share price today, it would have the Nike earnings estimates. So you have the Nike forward multiples, Nike revenue and EBITDAs, and you have the Nike WACC. So basically what I just did for YUM, each of your teams with the data sets in that team folder can do the same thing for your own team project companies. And this group project is going to be due in 2 weeks. But what I would recommend is between now and our next class, which should be next week, basically try it out. So that way, if you have any troubles, you can ask about it during class next week. Now, let me tell you what else is coming up in the group projects. You're going to have to do an EIC assignment, just as you did for homework 1 for your companies. So sitting in the team folders, I put in a file called ticker beta. This has the industry beta and the company beta, just as you did it in your first assignment for Starbucks. So the data here is now for each of your companies. I also gave you a spread. So just as you tried to figure out if the industry was attractive and whether they had competitive advantage, you have a spread file for your industry. So you have the industry attractiveness and you have the company spread here for each one of your companies. And then the final two files that I put in your folder, by the way, is I put in some analyst summaries. So it's called BICO, and this is Bloomberg Intelligence on your company. So this is basically a summary of all of the analyst reports. I think it was the cliff notes of the analyst reports as of today. So the first one is on the company, and then the second report I gave you is on your industry. So as you're trying to understand competitive advantage, as you're trying to understand growth rates, as you're trying to write up the 5 forces, I gave you recent research which you can use as part of your group projects to help you for each one of your companies. Now, I will say, as you use it, don't plagiarize if you put it into your PowerPoints, reference it, but nonetheless, I tried to give you data to help you as you try and come up with a valuation for each one of your companies. So Nike has its own folder in the team projects. You also have one for Halliburton. You have one for CVS, and you have one for Royal Caribbean. The one file I didn't talk about tonight, which we'll talk about next week, is I did put in the multiples. So you're going to do an assignment on multiples for next week. And so I went ahead and gave you the multiples for your companies so that you can also talk about the multiples part of your group project as well. And you have the data for the multiples that syncs up with your valuation. So all of the components mathematically to do your valuation are in those team folders. I want to make sure you knew that they were there. Tell me if that conceptually makes sense.
Professor, I've got a quick question. I'm in the RCL group.
Yep.
And I'm just looking through the file, and it doesn't look like we have the raw data for ours.
You're talking about the
actual Excel file?
You're talking about that file seems to be missing, the RCL data?
Yeah, unless I'm not seeing it, but I don't see it in my...
It's possible.
Yeah, I don't see it either.
All right, your RCL?
Yeah.
Well, let's do this. Okay, should be there now.
Cool, thank you.
Raw data should be there now if you refresh. And again, what I want your team to start thinking about is when you practice, use this as is to insert. Now let me go back to YUM and talk about the other 4 files, Excel files that you'll need to create. So just as I quickly did YUM, and if you watch the video in more detail and time, I did McDonald's. The next step is to create a bull and a bear. So let me talk to you about briefly how I'd like you to think about the bull and the bear. First, read the competitive intelligence of the company and the industry and do your own research. This is where the EIC can help you, as well as some of the historical analysis. But basically, assuming you've done it, right, which I'm kind of skipping that step, then what I want you to do is focus on changing really 5 numbers. You can choose to change more, but these are the minimum 5 numbers, and really it's 4 numbers I want you to think about changing. 1, revenue growth from the as is. 2 is EBITDA. 3 is tax rate. And 4 is G. 5 could be WACC, but to be honest with you, we tend to use a target capital structure, so the WACC shouldn't change that much for these companies. So you'd have to have a really good reason to change the WACC, so I probably wouldn't change the WACC, but nonetheless, that could be one of the 5 variables to focus on. As I said, you can always change something else, but this is the 90-10 evaluation. And so once you've done your as is, let's start out with the pessimistic scenario. So for those of you that know KFC, Taco Bell, and Pizza Hut, and they're now global, what do you think in the next 12 months could actually be a negative scenario for them on revenue. Like if this is what the market's expecting for them to grow about 3%, if we got into a recessionary environment, like I don't know if you paid attention last week, but last week the Federal Reserve said they're stopping raising interest rates. Interest rates inverted in the US and yields to maturity went negative in Europe, which are generally recessionary signs. So if we went into a little bit of recession, what do you think would happen to the growth rate of YUM? If it wasn't 3%, what would happen to it?
It'd probably go down even more.
So
I would say it's probably, I mean, I'm not sure what their beta is off the top of my head, but I think it's viewed as an affordable food option. So I think it would be less elastic than some other more premium priced restaurants.
all right. Well, first of all, I like the thinking about the beta. So thank you for bringing that back in. So let me put that up for everybody. Their beta is 0.66.
So that's relatively low, right? I mean, it only moves 60% of the market.
Yep. And their peers are, all the restaurant peers are low, with the exception of YUM China, but we're dealing with YUM, not YUM China.
Professor, I'm just thinking back to whenever we did our EIC for Starbucks, I think week 1.
Yep.
And it was saying how, Starbucks and YUM, all these brands are kind of in the same boat. And as consumer spending decreases, that actually hurts these brands.
So what are we talking about? 1% growth, 0% growth, negative 2%? Give me a number.
I'd probably say negative.
All right, let's use negative 1%. Okay, and I'm going to say negative 1% for a few years. More just struggling few years. All right, now, next question is EBITDA margins. Obviously, they've been bouncing around historically, so using historically is going to be really challenging. All right, so the last few years, these are what the analysts are saying, about 39% down from 42. So in a recessionary environment, they're probably going to cut costs, cut marketing. I don't think it's going to drop off the table. But let's say it got to 38. They lost a point of margin. Couldn't monetize their business as much. So, and I don't think it's going to affect them long term. It's just a short term recession. They still have some good dynamics long term in the market for growth, and especially outside the US. So I'm not going to change the G. And I'm not going to change the tax rate. I'm going to leave the tax rate about the same. So here's the point. I see the downside risk, and I'm going to call this my bear scenario, of about 83. So I'm going to save this file, save as, and I'm going to call this the bear. This is my YUM, instead of as is, this is my YUM bear. Okay. Next, what I'm going to do is I'm going to take my happy pill. I just woke up and I just have a completely different rose-colored glasses view of the world. There's no recession. What are you talking about? These are just indicators that are flashing abnormally and everything's going to be fine. Matter of fact, I actually think that they're going to be successful in their marketing. They're going to continue their expansion even better into all these other countries, and they're going to grow even faster. So give me the best case scenario. If the market thinks they're going to grow 3%, if they actually execute better and they do even better, what kind of growth rates do you think they can get? Remember, this was 3 a little while ago. So how much higher than 3 can they get realistically? Anybody have any thoughts on that? Again, you guys did the EICs for Starbucks? Five, 6, 7?
I was going to say, what if you just added 2%?
Okay.
Made it a 5?
Let's put in 5. Now, when you say add 2%, I'd like some exposition, if this were your team, about where the 2%, why 2%, why not 3%, and where it might come from. We can add 2%. In fact, I took away some of the margin. Remember, this was 39.4. So what's going to happen to the margin? Could it get even higher? Could it get back up to 43, where it was last year? Because the analysts are forecasting a drop in their margin. Could they get back to better days?
I think it's just hard to make like a case for it to be higher than 3%. I mean, if you're talking about margins, you know, with wages going up and just cost of materials and stuff going up.
Maybe if they were more efficient, like if they developed an efficiency in their process.
Well, there's both efficiencies and the ability to change their mix a little bit for higher pricing mix. You know, I'm not saying they're coming out with things that we all want to go buy at higher price, but maybe. So, but again, remember, this is the optimistic scenario. It's not the realistic scenario. It's the optimistic scenario. So the optimistic scenario, maybe the wage growth doesn't hurt them as much. Maybe they're able to get those efficiencies. Maybe they're able to grind out, we'll call it 41%. Okay? I'll make these 41. And again, I'm not going to change their long term, but here's the point. That's 112. And I'm going to call this my bull. So what I've done is I've established 3 data points. Stock price today is trading around 99. In a best case scenario in the next 12 months, or a more likely best case scenario, I think they can get as high as 112, assuming that the wage raises worldwide are not an impediment, that they get some offsetting operating efficiencies, and they find ways to grow a little faster with their emerging markets. I think in the pessimistic scenario, they can get down to the low 80s. If the wages really do affect them, erode their margins, and we see a kind of a recession which could erode sales growth, and they have to retrench a little bit. So I've established my boundaries. I have today, I have an upside, I got a downside. Now I'm ready to do my target. Where along that range do you think YUM is going to end up? See, now you put in your opinion. So the first is your positive opinion. The second was your negative opinion. Now your realistic opinion. So when somebody said a second ago, I don't think the whatever will be whatever, I think you were getting towards that realistic opinion. Now you're ready to talk target with me. What's your target? What are some of your target recommendations? What would your target growth rate be? What would your target EBITDA and or tax rate be?
I had a quick question.
Yep.
For the first 3 years of forecasting for EBITDA, should we always be pegging to the consensus for revenue and EBITDA from Bloomberg?
Not necessarily. When you get to the bull and the bear, you can always go against that. And you can do the same thing with the target. I was just using the out years for simplicity. The only time I really want you to use the Bloomberg first 3 years is for the as is. Because those consensus estimates that I gave you are the wisdom of the crowd Wall Street, and most of the big institutions are going to be pretty close to those numbers, plus or minus a little bit in their spreadsheets. So, and the reason I know that is because Starbucks was trading at that price, or YUM is trading at this price, because that's the way they trade at this price. So I know that the institutions have to be using something pretty close to this, hence why we're doing the as is, to trade at that price. So for the as is, I want you to use the earnings estimates. But once you get to your target, you can disagree. What I want you to tell me is why you disagree. So that's going to be the key to how I'm going to grade you, right? So again, I can disagree with you, but I can't say you're wrong, okay? So as long as you're being reasonable and somewhat fact-based. So what I don't want to see is we have an invasion from Mars, and that's what's going to lead to, you know, all hell breaking loose. Well, that's not very realistic, knock on wood. So therefore, that's not going to be viewed very reasonably, right? But if you talk about the context of the business, that's why I gave you the industry research report and what's going on with the company. You do your own research, read through the 10Ks and Qs, you know, do some other research on the company, or you have your own personal opinion. Anecdotes can also be helpful. then that's okay. Because like I said, if you're following the process and doing reasonable, then I can't judge you negatively. Because we are dealing with the future. And I'm just telling you, in the real world today, the analysts themselves cannot agree on YUM. I mean, going back to what I was trying to show you here today, on YUM brands today, just as I showed you with Starbucks, if I look at the analysts, ANR, of the analysts, 10 buys, 13 holds, 2 sells. And they're all over the map. You have Jeremy Scott from Mizuho at 84, and Jeffries Andrew Barish at 85, and you got David Tarantino at Baird at 106, and this person at Argus at 116. They're all over the map. And again, only time will tell who's going to be right. So that's back to the real world. I mean, you know, there's sometimes it's easy to get consensus on companies, sometimes it's not. There's a little bit more uncertainty here with this company. And again, they're in a Starbucks world. They had a pretty good run in stock price. Right now, people aren't expecting any upside in 2019. And for the people that are, the others would probably view that as risky. Right? So again, not saying they're right or wrong. It's just, you know, somebody asked me today, they said, do you expect a recession? I was like, well, I haven't had one in a while, and I know that they're eventually coming. Can't tell you what the timing is, but you know, if I could predict that, we can make a lot of money off of it. But that's kind of what you're doing, is you're trying to make some guesses. And if you really want to use pessimistic, Goldman Sachs. This woman from Goldman Sachs is really pessimistic on YUM right now. Not saying she's right or wrong, but she's pretty bearish. So obviously, as you're doing your own thoughts over the next couple of weeks with your companies, you're going to take some of that into consideration. Questions? Does this make sense? I know I threw a lot at you tonight. Check the chat group. All right. So as we get to the end of our session tonight, a couple things. Number one, it is my understanding that we have class the next 2 weeks. Does anybody else have a different understanding? I mean, I'm going to go back and validate that with Elms, but I was told it was 5 straight weeks. So
I think that's right. I think Elms just looks I think the last 2 weeks in Elms just look like they're pushed out.
Okay. So I'm going to correct that and validate that with the MBA office tomorrow, but I'm pretty sure it's just we finish, because I think these are the dates that are correct right here in terms of when we're having our classes.
Yeah, but if you look at like the due dates of the assignments.
Yeah, I think somehow they got messed up, and my apologies for that. I'll get that cleaned up. So let me just talk about when assignments are due when. So next week, so a week from today, this should be an individual assignment form. That should be April 3rd, not April 10th. And in individual assignment 4, you're basically going to work on multiples. Okay? And then you'll use this template, and I'm going to add a video tomorrow on multiples to help you with the multiples. I'll put it right here so it's easy to find. And so to help you with that assignment on multiples, and that'll be due a week from today. And by the way, that same assignment will help you do your group project for multiples. So that'll be due a week from tomorrow, and I'll adjust this by tomorrow morning. That's a week from today. Then the midterms exam will basically be between next Wednesday and whatever the final week of class. You'll have a week to take it on your own. Okay, that'll be the midterms. And then the final class in 2 weeks, 2 weeks from tonight, which is 40% of your total grade, so this is the one that matters, is your group valuation project. And so what's going to happen, you can see it here, is each of your teams are going to get 15 minutes. And you don't have, each of your teams gets is it 20 minutes? Do we have enough time? 20, 40, 60? You're going to have to get 15 minutes because we have 4 teams, not 3 teams. So I'm going to have to adjust you guys down to 15 minutes. Make it easier for everybody. We're going to be on Zoom. You're going to have the floor. You're going to be able to present from your local computer. You're going to put in a PowerPoint, and you're going to cover those 4 sections in your 15 minutes of presentation time. You're going to put together a PowerPoint with all your data in it, so it's easy for the group to follow along. You're going to do an EIC for your company, Royal Caribbean, Nike, Halliburton, CVS. You're going to do a historical analysis for them on their ROIC tree and their CFI. You're going to do a multiple analysis, which is similar to your homework assignment next week. And then you're going to go through your valuation with your as is, and more importantly, your bull, your bear, and your target and your rationale. And that's it. And that will finish up our semester. So that's what we're going to be doing in the next 2 weeks. All the pieces of the puzzle starting to come together. You now have the data for your group projects. So hopefully everybody is equipped to start working on that. I know it was a lot quickly. So as you're working on these things, if you have questions about any of the data I gave you, if you have any questions about the way the model works, please send me emails. And if you're looking for other information you can't find, I might be able to try and give you some other things I can find on Bloomberg. I'm happy to put it in those team folders. But at least the minimums that you need to do, we covered in previous assignments, should be there as of tonight. And as I said, I put up the video, longer video on McDonald's. This video that we had of tonight's class will be summed up so that you can go through this and use the YUM model to start doing your team models. And then I'll put up a link so we can do a Zoom next week. Got 2 minutes left.
Just a quick question about the presentation, the Word document that needs to be submitted.
Yep. I'm killing the Word document.
I'm sorry?
I'm killing the Word document. You're just doing a PowerPoint.
Oh, okay. Okay, got it. So there is no Word document.
You're going to basically do a detailed PowerPoint. So think of it as PowerPoint plus. So
okay.
I want everything that you need to basically say about that company in that PowerPoint document. And then on the video, you're summarizing for me. So rather than turning in 2 files, I'm going to make it simplistic for you guys. You turn in 1 file, and the PowerPoint is to summarize. So that way, you guys, I know some of you work. You're doing the same thing. So I'm going to simplify your exercise. You're just doing 1 document, but you need to summarize it in 15 minutes and cover it all in that 15 minutes. So that if you don't cover the document in 15 minutes, you will be penalized. So you have to cover all 4 sections during that 15 minutes. But nonetheless, all the data is going to be in PowerPoint, not Word. That is the lingua franca of business. So that's the lingua franca for this class. So great question. We made that simple. Anything else I can simplify? All right, just last check. Anybody have technical difficulties tonight?
No, we were great. I like Zoom.
Much better.
Okay, so then we will use Zoom for our next 2 classes. So basically, one thing I will test next week is that I'm going to ask a couple of you to share your desktops next week, because that's going to be important as a test for our final presentations. Because in order to do the presentations, I need to be able to passively listen to what you present. So as part of the homework assignment next week, we'll get a couple people to share what you did with the either, I'll just say, the homework assignment and the multiples, and or if you want to share any of your progress in your evaluations, we can use that just to quickly test the software next week as well. So I'll send a different Zoom link and I'll put in the announcement so we can all get there. This class was recorded very shortly. I'll process the recording. I'll put it on YouTube. And so it's easy for anybody to access. And just so you, again, know where it is, in the modules tab, I put last week's class here, the video of the March 20th session, That's a YouTube link that we recorded last week in Zoom. And then tonight, they'll be right here under the module 3, the YouTube link for tonight's class. And as I said, I put up a video of McDonald's so you can see how what I talked about was added and refilled was there as well. All right, well again, grades for the first 2 assignments are also posted. Let me know if you have questions about that. And otherwise, I'll see everybody a week from tonight. Have a good evening.
Thank you.
All right, take care.
Thank you.